Hi everyone. We are Team Cap. We have done an analysis of Sime Darby's business performance. We are going to discuss does the company has a good or bad performance by analyze its financial report. First of all, let's look at the profitability ratio. Profitability ratios are used to measure the profitability of the business in terms of various return. The ratios below are the example of profitability ratios. Gross profit rate is the percentage of the sales dollar earned as gross profit. Net profit rate is the percentage of the net profit from every sales make. Expense ratio is the percentage of the sales dollar consumed by each expense. Asset turnover is a measure of efficiency calculated by dividing sales revenue by average assets. Return on asset gives an idea as to how efficient management is at using its assets to generate earnings. Return on invested capital gives a sense of how well a company is using its money to generate returns. The gross profit rate of the business has decreased by 2.19% from 2014 to 2015, and this is mainly caused by a highly increase of cost of revenue. Besides, there is an increase in expense ratio by 0.16%, even though the total operating expenses has decreased, the sales has decreased more. Thus, it causes the expense ratio increase. As a result, the net profit rate has decreased by 2.16%, which is lower than the decrease rate of gross profit rate. This is because there is a slightly decrease of total operating expenses from 2014 to 2015. Moreover, the decrease of 0.1% of the asset turnover might cause by the company has buy a new asset but haven't started to use the asset to generate revenue. Also, the return on asset has decreased by 2.65%, and it is caused by the business had a high purchases of fixed assets in 2015. The return on invested capital has also decreased by 3.39%. This is due to the decrease of net profit and the increase of tax rate. Next, let's look at the efficiency ratio of this business. Efficiency ratio is a ratio used to measure how well management has employed the resources of the business. Days sales outstanding, days inventory and payables period are the examples of efficiency ratio. Days sales outstanding measures the average number of days that a company takes to collect revenue after a sale has been made. Days inventory measures a company's performance that gives investors an idea of how long it takes a company to turn its inventory into sales. Payables period shows the number of days it takes the business to make payment for purchases on credit. Days sales outstanding of the business has increased by 5 from 2014 to 2015. It indicates that the number of days that the company takes to collect the revenue after a sale has increased by 5 days. This might be due to the debtors take a long time to pay the debts. Besides, the days inventory has decreased 88 days from 2014 to 2015. It means that the business take less time to turn its inventory into sales. This might cause by the business has produced a new product in 2015 which is highly demanded and so cause the days inventory improve. Furthermore, the payable period has improved by 103 days. This improvement is due to the increase of free cash flow which make the company pay its creditors faster. However, the payable period is still too high as the business still took a very long time to pay to its creditor. Free cash flow ratio is a ratio that illustrates the percentage of free cash flow to the amount of sales. The numerator is found by determining a company's free cash flow, which is available to debt and equity holders. The denominator is the company's annual sales. The free cash flow ratio has increased from 2014 to 2015 by 0.22%. Even though it has improved, it is still not good enough for the business because this is just enough to pay the short-term debts and the company still face a problem of paying its future short-term debts. Liquidity ratio is a ratio to measure the ability of the business to pay its debts within the next 12 months. Current ratio and quick ratio are the examples for liquidity ratio. Current ratio is used to examine the relationship between current assets and current liabilities. Quick ratio is used by companies to calculate certain financial ratios that are used in decision making. The current ratio has decreased from 2014 to 2015 by 0.37%. Current assets such as debtors, cash at bank and stock has decreased. At the same time, current liabilities such as creditor might has increased, so this result a decrease in current ratio. At 2015, the current ratio is at 1.67. It shows that the business has sufficient money to pay its debt before due but they would have no extra money for investment. In the other hand, The quick ratio has also decreased by 0.2% from 2014 to 2015. This shows the business does not have sufficient quick cash such as payments from debtor or cash in banks to pay its short-term debt before due, so business might not even earn interest from creditors. Financial stability ratio is a ratio to measure the short-term future of a business. Financial stability looks at the long-term structure of an entity. The examples of financial stability ratio are gearing ratio, debt, equity ratio and interest coverage ratio. Gearing ratio, also known as the debt ratio, measures the percentage funded by borrower funds. Debt/equity ratio calculates the percentage of total asset provided by either the owner or liabilities. Interest coverage ratio determine how easily a company can pay interest on outstanding debt. Gearing ratio has also increased 6.64%, and this shows that the business has more liability than assets. Refer to debt/equity ratio. As the business is more rely on borrowing as its source of capital, it increase the liability and cause gearing ratio increase. The debt/equity ratio has increased by 0.1% from 2014 to 2015 as more of the business capital is now financed by the borrowing. This shows that the businesses rely more on the borrowing instead of the owner-owned capital. Next, the data of interest coverage in 2014 is not provided and it is 15.84 in 2015. This shows that the interest coverage is still good as the business is able to pay its interest of borrowing because the free cash flow is high. In an overall, the business performance from 2014 to 2015 has deteriorated. This can be seen through the comparing between the financial report of 2014 and 2015. Thus, we have suggested few strategies for the company to improve the business performance. First, the business should increase the selling price of stock, control its expenses and buying stock from cheaper resources in order to increase the net profit. Last but not least, the business need to promote its stock and change the product to one that are more preferable by customer as a result to increase the sales and the stock turnover.